Hello and welcome to this February 26, 2010 video version of Invested Central's Chart of the Day. I'm Tom Boley, Invested Central's Chief Market Strategist, and it's my pleasure to provide you with today's Chart of the Day. This Chart of the Day is brought to you by StockCharts.com, simply the web's best financial charts. Today we're featuring a relativity chart. This is one of my favorite charts in trying to determine the overall message of the market. You might hear us refer to the message that's being sent by the market. This is the way we can put it in visual form. And what I'm talking about here is where you have we take a look at two sectors, one being the consumer staple sector and the other being consumer discretionary. And when we take a look at these two, it kind of makes sense from a common sense standpoint that when the stock market is going down, like we saw from the market peak in October of 2007 all the way to the March 2009 lows, during that entire period where we were seeing prices decline, we actually saw the relative ratio of consumer staple stocks to consumer discretionary stocks rise. So the whole time prices were falling here, you can see that the ratio of consumer staples versus consumer discretionary was actually on the move to the upside. Now there was what I would refer to as a slight, I guess you would look at this as a negative divergence, although I think for the market it was more of a positive divergence. But as we made the March lows in the S&P 500 versus the November low that we had seen, take a look at the ratio here. Even though prices moved lower and we would have expected this ratio to then move higher, that's not what happened. We actually saw prices move lower on the S&P, but this ratio also came down. So it was starting to give us an early signal that money was no longer flowing to the XLP, or the consumer staples sector, to the detriment of the consumer discretionary group. So I think this combination right here and this negative divergence, or like I said, maybe a positive divergence depending on how you look at it, started to send a message that even though prices were going lower, the money was not necessarily flowing away from consumer discretionary and going toward consumer staples. And the reason this is important is that in periods of economic weakness, when things start to get weak and the economy is weakening, everyone starts talking about recession, the things that people still buy belong in the consumer staples group. You're still going to get your toothpaste and deodorant and stuff like that is a necessary everyday type of thing. Those are the types of things that make up consumer staples. Your consumer discretionary stocks are going to be like retail stocks. Folks are going to maybe not go out to the Abercrombie and Fitches of the world during an economic downturn. They're going to start cutting back on their discretionary spending. So that's why, as the market moves lower and the message that's being sent is that the economy is on the decline, that's why you're going to see consumer staple stocks outperform. Now on the flip side, when the market is moving higher, you're going to see the consumer discretionary group outperform, and we're going to see a downtrend, which is what we've been seeing. Now, as we sit here on February 26th and we're looking out where this market might go, the one encouraging sign that I'm seeing is, even though it looks like this market wants to roll over and is maybe in the process of doing just that, we're not really seeing too much money flowing into the consumer staples group versus the consumer discretionary. I personally think that is a good sign, although I do believe that over the course of the next few months, if we are in a flag pattern and the market shows a little bit of downward bias, that we could see this ratio jump up, maybe hit this initial relative resistance area around 0.96, and ultimately could get all the way back up into this major resistance area around 1 to 105. But that remains to be seen. I think in the meantime, in the near term, this is still a somewhat bullish outlook on the market down the road once we get past this potential flag. Anyway, I hope you've enjoyed our presentation today. Be sure to check out our chart of the day every day at investedcentral.com. While you're there, sign up for our free weekly Market Pulse newsletter and have the chart of the day emailed directly to you. Happy trading.